updates. Today, really talking about the housing market. It's big in the news, it's all over the news. I'll probably be on the news a fair bit this week. Obviously talking about the policy changes last week. Bright line test change, moving that from 5 to 10 years, kind of expected, and to be honest, no big drama there. But the one that took everyone by surprise was the removal of interest deductibility. Look, from my perspective, I'm not political. I don't like politicians, full stop, doesn't matter what colour they are. The problem I have with it is that you could put such a big policy change through without really understanding the downstream implications. I think this is pretty serious. I think everyone's washing over it quite lightly at the moment. So let's dive into it a little bit, explore it in a bit more detail, so that you can sort of get a bit of a sense for why I'm ranting about it. So the challenge with the removal of interest deductibility is, who does it really impact? And if we sort of start to unpack, that's a great place to start. So the reality is there's a bit of an urban myth really around who property investors are. There's this kind of narrative that they're driving around in Bentleys and Rolls Royces and it's the uber rich of New Zealand, and it couldn't be any further from the truth. The reality is that really wealthy people don't buy residential property. They own the Auckland CBD, they own commercial property, they own land banks, and they own companies. They don't own residential property. The last thing that they want to do is have to deal with tenants. The bulk of residential property investors are just regular, hardworking mum and dads, that are wanting to get ahead, just wanting some level of financial independence. And we've been pushing that in the market for the last 30 years. And there's 200,000 to 300,000 property investors out there in New Zealand, and they look like everyone else. I've been to plenty of conferences, and you would struggle to differentiate them from a homeless person, honestly. They tend to be frugal, not spend much money, and really look after their property portfolio because it's their way of saving. When you sort of start to unpack it and you realise that that's who property investors are, well then what's the downstream impact of all of this? Fundamentally, you cannot take 30% of the revenue out of any form of asset and not expect the price of that asset to fall. So, all things being equal, this should have a pretty big and negative impact on house prices. That might not happen because we've had a shortage of property, we've got a lot of buyer demand out there, particularly from first home buyers, but also people coming back to New Zealand and people upgrading. So one wouldn't expect it to translate straight into house prices, but you look at it longer term and you'd certainly expect it to have an impact. The other thing that's playing out in the market at the moment is really low interest rates. What you would say with this change is that it's going to take off any pressure to put interest rates up, so we can expect to see interest rates stay low for a long time. There will be a bit of an emerging story, largely out of the sort of property spruikier community around now's the opportunity to buy new builds. And look, there's a little bit of truth to that because we don't know the detail of the new law yet, but we're hearing that new builds will be exempt from the bright line test in terms of it moving out to 10 years, and also from this interest tax deductibility. But fundamentally, it doesn't change the nature of residential property because, sure, you buy something new and it's tax deductible, but when you come to sell it, it's no longer new. So whoever's buying it off you is still going to be assessing that property as a second-hand property. So fundamentally, yes, new builds are exempt, and maybe it sort of helps the market a little bit in the short term, but it doesn't change the underlying characteristics of that asset. So, I don't think new builds suddenly going to save the market. The other interesting thing is that, with this tax change, it's going to change the bank servicing calculators. So banks are going to significantly change their calculators, reflecting the fact that investors are going to have 30% less income coming in on their properties. That could tip a load of investors into negative servicing territory, where banks sort of look at them and go, actually, you shouldn't have that much money. So what happens there? If someone's selling a property because they need to liquidate cash, The bank could take all the proceeds from sale, which we've seen time and time again when the market sort of turns, right? You're a business owner, small business owner. A lot of small business owners own investment property. You go to sell the property, maybe to liquidate some cash or some working capital for your business, maybe something else is going on in your life, and the bank takes all the proceeds. So all of a sudden, that asset that you had that you were relying on for working capital is no longer doing its job for you. You're an investor, you're selling your property in, say, a traditionally rental suburb, maybe somewhere in South Auckland, could be any city in New Zealand. Who's going to buy it off you? Because see, here's one of the dilemmas, and it's probably a bit of a paradox for labour, is that who's going to buy off investors? And we keep hearing, well, maybe first home buyers. Well, sure, they will in up and coming suburbs and places that first home buyers want to live. But here's another problem. Half our population can't afford to buy a house. It doesn't matter what we change at the moment, they still can't afford it. So, these changes aren't going to get a lot more people into home ownership. First home buyers that can afford to buy are buying. Now, yes, house prices have been going up and it's been a tough market for them. And this should make it easier for them to buy, but it's not a miracle cure for the lack of affordability that exists in our market. So when property investors are selling in South Auckland, who's going to be buying? And if no one's buying, what happens to house prices? So you can sort of see the downstream implications of this in terms of a cash flow crunch, in terms of small business owners maybe not having the liquidity or working capital that they thought they might have. The implications for renters in areas where investors are selling, and maybe first home buyers are buying, where are they going to move to? But then what happens in parts of the market where they simply go cold? People want to sell but nobody wants to buy. The implications of this are really, really significant. And I come back to the point, you don't go and put in major tax policy change with this level of implication without doing the analysis. And if anything, that's what kind of scares me, is that we don't really know the outcome of this yet, and we probably won't know for another 6 to 12 months. But I'm not sitting here thinking that this is insignificant. This is significant. I don't think this is one of the things that you can brush over. If you're a first home buyer, look, it's fantastic news. I think it's really going to unlock the door for you to be able to buy a hell of a lot easier than you've been struggling in this market for the last 6 to 12 months. That's a real positive. And something did need to change to sort of bring this market back. If you're a property investor, I think this is really significant, and you really do need to be reviewing your portfolio, having a strategy, talking about it. Don't put your head in the sand. The implications of this change, not necessarily for you directly yourself, but for other investors, and therefore, that sort of secondary impact on you could be significant. So, it's well worth having a really good think about. So that's the update from me. Sorry, it's not more positive, but hopefully it gives you a bit of a frame of reference for thinking about what's going on.